I want to bring in Lauren Goodwin of New York Life Investments and Stephanie Link from Hightower. Steph, of course, also a CNBC contributor. Thanks very much to you both for being here on a Friday. And also, let's build in, Lauren, a little bit of this bank situation, the stress that we've been experiencing, and even the way that the market has tried to create this firewall around a couple of banks, and what it meant for the bull case, the bear case for stocks, and also the risk of recession here. Does it allow the market to have some relief, or not so much?
Well, of course, the bear case is bolstered by bank failures because of credit conditions. The idea is that tightening credit conditions will work their way through the economy, make a recession come a bit quicker. And we'll largely see that through employment, actually, because tightening credit conditions are very closely tied to how companies are able to keep people, especially in small and medium-sized companies that may be losing their first lines of capital from the banking sector. So that's where the bear case has lied. It's interesting that the Fed has not been convinced by that line of thinking when it comes to signaling whether, especially in this March meeting that we last saw, signaling whether they'd be able to slow their pace of interest rate hikes or even pause earlier. They said, look, we're not seeing evidence of that. And so the fact that we're seeing employment costs still higher today suggests that the idea that these tightening credit conditions have already accelerated the path towards recession hasn't happened yet.
That is true. And Steph, for sure, Powell in March at the last meeting did say we're not seeing the evidence yet. We don't exactly know how to quantify it. But he also said we did consider pausing and not hiking in March. And so I wonder if right now we can be comfortable that another quarter point hike next week. Maybe there's a signal that they're data dependent, or there's sort of the market takes it as a pause. And then we're left with an economy which, at least based on the data this week, seems to be holding up OK.
It's been amazing this week, right? In the face of all of these concerns, not only is it the bank failures and tighter credit and lending standards, but it's the geopolitical issues as well as the debt ceiling discussion or argument or lack of one. So in the face of all of this, and in the face of the Fed being very hawkish, you actually did get good data. You got better GDP, not on the surface, but underneath. Personal consumption up 3.7%. We know the consumer is 70% of the U.S. economy, so that's good. Initial claims are a far cry from the 370,000 weekly initial claims during a recession. They're at 230 this past week, so really good on the job front. And, of course, inflation is coming down, Mike, as you know. It's definitely coming down from the peak, but it is still elevated, and that's the reason the Fed is going to go next week, and they could go the following month in June. We'll have to wait and see. But the bottom line is we're in the 8th or the 9th inning of the Fed hikes. They're going to keep rates high for a long period of time. But if they're at the 8th or the 9th inning, and to your point, if they're a little bit more dovish in their language, I think the market can go even higher. I think the market, again, has been so resilient in the face of all of this negativity. That's a good sign. It's led to much better than expected or better than feared earnings as a result.
Yeah, and Lauren, this whole debate really illustrates why the market is caught in between, because everything we're saying that looks pretty good right now can be answered with, yes, lagging indicators. It often looks this way as you head into a downturn. And the market has absolutely been resilient, but it's also been a little bit of a less clear picture underneath when you have just the big growth stocks doing most of the work.
That's right. And that's something that I came out on this program and said last week I did not expect to see this week, that, yes, likely the tech stocks that released this week would do well, but I didn't expect the valuations to move quite as high as they did. Now, what that does, that the picture that paints is that the market is telling a story of disinflation, that, yes, recession may be on its way, but it's not here yet. And we're probably more excited on aggregate about that disinflationary story, the lack of threat from the Fed, at least to hike more than they've said for the last 9 months they're going to hike. But I have to agree with Stephanie that probably the risk to the market now is that we see more hikes rather than less. And so from an investment perspective, we need to be balanced as investors, be ready that rates volatility isn't behind us.